Welcome back to our latest explainer. Today we're doing something a bit different. We're going to spend the next 7 minutes or so building a completely wholesome, ground-up understanding of a topic that, frankly, stresses a lot of people out: investing. We're completely stripping away the flashing green and red lights, the anxiety, and all that intimidating Wall Street jargon. Instead, we're going to look under the hood and reveal what is actually a surprisingly simple, totally understandable machine.
Okay, to kick things off, let's draw a really crucial line in the sand. A lot of us just kind of blend these two ideas together, right? But saving and investing are totally different animals. Saving is fundamentally about keeping your cash safe and idle. It's pure protection. You know for a fact it's going to be there when your car breaks down, but it isn't doing any real work while it waits. Investing, on the flip side, means moving that money into something productive, and yeah, slightly uncertain, so you can actually participate in its growth.
So, let's get right into part 1, why investing actually exists in the first place.
You know, most people hear the word investing, and their brains immediately go to trading apps, crazy line charts, or basically just gambling. But investing exists for a much simpler reason. It's just a fact of life that money sitting completely still slowly loses its power to do useful work. Think about it like you're deciding what to do with a big harvest. You can keep all your grain in a reliable burlap sack. That's your savings. It's safe, sure, but it is definitely not going to multiply in there. Or you could take that same grain and plant it as seeds. Now those seeds have the potential to grow into a massive harvest, provided you're willing to accept just a little bit of uncertainty about the weather and the soil.
All right, moving on to section 2, the engine under the hood.
Now that we know why we're planting those seeds, let's peel back all that confusing market noise you hear on the news and look at the actual gears driving this investing machine. The very first gear? That's return. Look, money doesn't just magically grow because time is passing. Return only happens when your money is tied to something genuinely productive. Imagine you own a tiny slice of a really successful local bakery. As that bakery sells more sourdough and runs more efficiently, it creates real, tangible value in the world. And because you own a slice, your slice becomes more valuable. Whether it's a business earning profits, a property generating rent, or even a loan paying interest, your money has to be attached to a living, producing system.
Which brings us to the second gear, risk. And we really need to redefine this scary word, guys. In investing, risk isn't just about losing all your money or facing some guaranteed financial ruin. It simply means the level of uncertainty you're dealing with. It's kind of like the difference between walking down a familiar, well-lit hallway in your own house versus crossing a narrow footbridge over a river in heavy fog. The bridge itself might be perfectly sturdy, but that fog represents your reduced certainty about exactly what's ahead.
Next up, section 3, price versus true value.
This right here is probably one of the biggest traps for beginners trying to decode financial headlines. People constantly mix up the price of something with its actual value. Picture an old solid-wood chair sitting at a neighborhood garage sale. The price tag is just the number the crowd is willing to pay today. It fluctuates based on mood, optimism, or maybe even panic. But the underlying value of that chair, that's anchored in its true usefulness. How solid are the legs? What's the quality of the wood over time? Price is basically just what the crowd is shouting right now, whereas value is what the asset can actually do over the long haul.
That leads us perfectly into section 4, the power of time.
Now this investing engine really starts to rev, it gets incredibly powerful when we introduce the fourth gear, time. Time is the magical force that turns small, repeated bursts of growth into absolutely massive results. We call this compounding. It's exactly like packing a tiny snowball and rolling it down a long snowy hill. At first, yeah, it's pretty small and honestly unimpressive. But as it rolls, it gathers more snow. And then that new snow starts picking up even more snow. The growth literally stacks on top of itself. Time itself isn't creating the returns, but it's giving your productive investments the runway they desperately need to accumulate.
Of course, as all that time passes, you're inevitably going to run into our next concept, volatility. Volatility is just the visible surface-level ups and downs of a price. When you see prices jumping around and the news anchors are freaking out, just remember the ocean. The surface of the water can get incredibly choppy and noisy, full of crashing waves, right? But way down beneath that surface, the deep, incredibly powerful current is moving steadily in one single direction. Just because the surface is choppy doesn't mean the underlying current is broken.
So how do you protect your journey across that choppy ocean? You use diversification. Diversification just means spreading your exposure so you aren't completely reliant on one single outcome. Honestly, it's exactly like bagging groceries. You wouldn't cram every single heavy can and glass jar into one flimsy paper bag, would you? Obviously not, because if that one bag tears, the whole trip is ruined. By spreading the load across several bags, you're just making sure that one single failure won't completely wreck your week.
Okay, let's bring all this together. When we look at this table and see elements like return, risk, price, value, time, volatility, and diversification side by side, you finally start to see the hidden structure underneath all that intimidating Wall Street jargon. These aren't just random, scary financial buzzwords. They're actually specific dials and gears on the exact same understandable machine we've been talking about.
Which brings us to Section 5, your investing mental model. Now that we know exactly how the individual gears work, let's actually turn this theory into a practical tool you can use. Forget about seeing investing as just blindly guessing which lines on a chart will go up. You need to start seeing it as owning a stream of possible future outcomes. Think of it less like reading a digital clock, which gives you absolute 100% certainty, and much more like reading a weather forecast. You're simply judging probabilities. You're asking yourself, what future outcomes might I own, and how much uncertainty am I realistically willing to stomach to get them?
A really perfect way to visualize this whole trade-off is comparing a heavy metal lockbox in your shed to planting an apple orchard. That metal box, that's your savings. It gives you absolute safety. You can open it whenever you want, but you get absolutely zero growth. The orchard, though, that's your investing. It takes time. It completely relies on the weather. And yeah, it requires a little bit of luck. But eventually, if you stick with it, it produces a massive harvest of fruit year after year after year.
Let's bring it home with Section 6, thinking like an investor.
So what does adopting this orchard mindset actually change in your day-to-day life? Well, it sparks a massive identity shift. You literally stop reacting to the daily market noise like some anxious spectator sweating over a sports game, and you start looking for underlying structure like an empowered system reader. You don't panic anymore when the surface of the ocean gets a little choppy, because you actually understand how the deep currents, the machine underneath, are built.
Armed with this mental model, you'll find yourself automatically asking way better questions. Before making any move, you'll stop and ask, is this asset actually producing anything? How foggy is that bridge? Like, how uncertain are the actual outcomes here? Am I just panicking over some short-term price noise, or has the fundamental value actually changed? And, of course, did I just put all my groceries in one paper bag and leave myself totally overexposed?
The whole thing boils down to this one brilliant quote. Seriously, if you take away nothing else from this explainer, remember this. Investing is the management of productive ownership over time. That's it. It is not about owning a crystal ball and perfectly predicting the future. It's just choosing to participate in real productive growth, managing your uncertainty, and then giving it the runway it needs to compound.
As we wrap up this explainer, I want to leave you with one final, kind of provocative question to chew on today. Look at your own financial machine right now. Which future outcomes are you actually setting your money up to participate in? Are you keeping every single cent locked away in that dark metal box, or are you finally ready to start planting your orchard? Thanks so much for joining me on this journey under the hood, and I will catch you in the next explainer.